Our session today is basically lesson 1, where we're going to discuss the principles of bookkeeping. For you to be an accountant, a financial manager, you need to understand what accounting is. I'll give you a brief history description of accounting and the relationship that accounting and bookkeeping have, the main users of financial accounting information, how to understand the accounting equation, the relationship between the accounting equation and the layout in the balance sheet. And also we're going to describe a few terms like what assets are, what capital is, liabilities, debtors, and creditors. And also we'll transition to explaining items of the accounting equation. We'll thereafter draw up balance sheets, income statements, trial balance, and ledger accounts in that order. So when we talk about financial accounting, we are talking about giving a report, a record of what? It's a statement of an event or activity. So accounting, if you may agree with me, starts from scripture. The Bible talks about giving an account several times to God. So just ask us to give a report on our activities, justifying them why we did what. So accounting can be defined in many ways. It is about recording the monetary transactions of an entity in accordance with established concepts, principles, accounting standards, and legal requirements in their presentation by means of what we call an income statement, a balance sheet, a cash flow statement at the end of an accounting period. So this is how we define financial accounting. We classify, we record. What do we record? Transactions. These transactions come in what form? In monetary form. So we don't use cows or goats. We use concepts called the monetary entity concept, which assumes all transactions to be done in monetary form. Now, these transactions have a format which conform to what we call accounting standards. These records or transactions have to abide by concepts that we're going to look at that should be uniform throughout and acceptable worldwide. These transactions must also be presented in a format that we're going to discuss at length. Using the following books, we have what we call the income statement, we have what we call the balance sheet, we have what we call the cash flow statements. These are the tools that we're going to use to present our data. So this is a wholesome and comprehensive definition of what financial accounting is. So when we're dealing with financial accounting, we're dealing with assets, we're liabilities, we're dealing with capital structure, we're dealing with debtors. Now, what are assets? These are things that the company owns. We call them assets. Who are debtors? The people who owe the company. Who are creditors? The people that the company owes. So these are terms that you need to understand. And we also look at how the company is being financed. How does money come into this company? The financial structure, the capital structure, the performance over years, how do we assess that? So basically, the purpose of financial accounting will be to fulfill the legal requirements, to also assist for planning, control, and decision-making for the managers. So when we're dealing with financial accounting information, it is not only to the business itself, but to other users of financial accounting. Now, in the context of accounting, accounting should take place within a business entity. Now, what do we mean by business entity? And what types of businesses do we have? We have a number of businesses that we need to know. We have what we call a sole trader. We have what we call a partnership. We have what we call a company and a cooperative. A sole trader is a one-man business who may also employ one or two to help him. He or she makes the decisions alone, as much enjoys the profits, and so enjoys the losses. He has what we call unlimited liability, meaning he dies with the business. We call this a business name. Disadvantages is that he has difficulty in raising up capital, and the banks may not give them loans because of their liquidity. Unlimited liability simply means that this person, their personal belongings can be taken should they be indebted because they are as good as the business. Partnership, she now finds other people to work with. This could be a carpenter, this could be a lawyer, and maybe she is a teacher. They partner with a document called a partnership deed. This partnership deed is a contract that could be oral or written. It stipulates how many hours each of them will work, how much each will put in the business, what tasks each of them will have. So this partnership has the following advantages. They will pull in the resources together. They'll pull in the skills. They will pull in expertise. And above all, they will share the risks. Disadvantage, they'll share the profits. That's a bad thing because ideally, man is selfish, wanting more to himself. Other disadvantage is that the wrongdoings of individuals will affect the whole partnership. So her wrongdoings may affect him or her. There also is what is called unlimited liability. The wrong decisions made will impact the partnership. Partnership is also complex. Personal conflicts may also affect the growth of the partnership. And so they'll graduate to what we call a company. By law, a company is a separate entity from the business itself. The business can appoint a board of directors who represent the shareholders. So these people now will protect themselves from this personal liability by being separate from the business. They will enter into an entity or a form of a business that will assume a personality under what we call the entity concept. The entity concept now gives the company rights to sue and be sued. These people you're seeing here have a special name called shareholders. These shareholders can be classified into two. We have those that we call the cumulative shareholders, the preference shareholders, and the ordinary shareholders. A shareholder who owns what is called ordinary shares is also called common stock or equity shareholder. These shareholders have voting rights. Advantages is that there is a larger pool of expertise, resources, and they have what we call limited liability. Private limited liability ends with LTD. A public limited company ends with PLC. Disadvantage, it's expensive to establish. It has more tedious requirements like the articles of association. You also have the memorandum of association, and it pays not only corporate tax, but also pay as you earn. These two only pay personal, pay as you earn. Cooperative, these are formed under a trust. Cooperatives that may have specific duty obligations. So I've explained sole traders are one individual main source of funds is that person, they may have employees. So we also went to partnership, which may have 2 or more partners. For a professional like a lawyer and accountant, these may also be 2 to 20. So partnership will outgrow a sole trader, and in a sense, they will have a few common characteristics, except that under partnership, the risk is now swallowed. So in a partnership, we have a partnership deed, which will now give implied and express agreements on how much will be contributed, what jobs will be done, how many hours will be spent, and what profits and losses will be shared. Examples of partnerships may be accounting firms, medical firms, and legal firms. Advantages is pool of resources and skills, risk sharing, no audits, and full disclosure of financial information, and they are not regulated. Disadvantages: unlimited liability, too much dependence on each other, and the partnership ceases when one member joins or leaves, and owners and partners are treated as one and the same should there be a wrong decision that is made. So this is what a partnership is all about. Company, I said, has a personality which is separate from the owners, meaning the liabilities of the company cannot be transferred to the shareholders. And these ones appoint a board of directors who represent the company. They can sue and be sued. We have 2 forms of companies, private and public. Private companies are registered and owned by individuals other than the public, like company AN with Limited, Ltd. Minimum of 2 directors and shareholders are required. They are not invited to have an IPO. An IPO is where they can issue their shares on the stock exchange. Are there any questions at this point before I proceed? Am I too fast or moving together with the rest?
We're moving together.
All right. Okay, now that we've established these different types of business structures, we now go down to understanding the users of financial accounting information. We have external and internal users. Remember, we said we would want to know who the main users of accounting information and why they're interested in it. So the users of financial accounting information include the following. We have the internal users, who include managers, directors, internal audit editors, and employees. The external are many. We have lenders, shareholders, governments, local authorities, analysts, journalists, suppliers, external auditors, customers, general public. We may also have journalists and potential investors. Why are these important to these people? Shareholders, they want to know the current and future profits because their investment are the shares. And so do the investors who are potential want to know how their shares will perform. Employees are interested simply in wages or pay so that they could know whether they should solicit for a higher pay or not. Trade union, these ones are very keen to this information because they want to use it for bargaining purposes. Customers need to know that the company will run for a foreseeable future, that they'll supply them with the needed supplies. Suppliers are interested because they want to know whether they'll be paid. Managers want to know for reporting and decision making. Competitors to make economic decisions that will give them comparative advantage. Government to collect tax. Lenders, they want to know whether these people will pay them. At this point, we'll do a quick can you remember before I proceed? Question number 1. Can
The
you?
questions, sir?
Yes, please.
Yes. Just about the competitors. So, how feasible is it to share accounting information with your competitors? Is it not just academic? Because in practical, real sense, is it possible for your competitor to approach you to say, I need to see your financial accounting? And is it the information that they are going to collect or the information I would decide to give them, is it going to be a reliable information for them to make a decision?
Okay, very good question. Is it true that competitors can access our financial information? Anyone to answer? Who on earth would want to supply their competitors information that they know clearly would disadvantage them? Is that just an academic rhetoric, or it actually happens in real sense? Someone to quickly answer. It's a very good question. Yes, I defined financial accounting as having a concept of legal requirement. So for companies that are public, like it or not, it is a legal requirement that they need to publish their statements, annual statements. Today, we're able to know that the banks performed very well. We know how is it Mizingamelo's bank financial statements showed that they did very well. So it's a legal requirement that they need to publish because it's a public company to show them or to show potential investors that I can invest in this company. The same access that potential investors have is the same access that potential competitors have, or our friends that outperformed us. So this is a legal requirement and it has no debate, but an exception for private limited company, they can hide. Even partnerships can hide, they don't need to publicize there. But for public, yes, they do. And for them to understand that, they need to have financial accounting information. Have I answered your question?
Yes, sir. Thank you.
All right. Any other questions before my 10 comes? Okay. Okay, so my question number 1. There are two types. There are two types of shareholders. Can you mention the two types of shareholders that we have in a company? Who are the two types of shareholders that we have in a company? We have the
The
private,
investors?
we have the two types of shareholders are the ordinary shareholders and the preference shareholders, isn't it? The ordinary shareholders are the ones with the voting rights, and the preference shareholders have no voting rights. A partnership, for them to come into form, they sign a document which is called a what? What is the constitution of a partnership?
Partnership deed.
It's called a partnership deed, yes. All right, so Can you mention the we have internal and external users of financial accounting information, and list any 4 internal and any 4 external users of financial accounting information?
Sorry, I didn't get the question. Maybe you can say that again.
We have 2 types of users of financial accounting information. We have internal and external users. So enlist any 4 types of internal users and any 4 types of external users of financial accounting information.
Okay, so for internal, we have managers, employees. Can I continue?
Yes.
So I said managers, employees, internal auditors, and the 4th one is, okay. I think I've
Directors?
managed to get this.
And directors, okay. Then external. Okay, so we can move. So we talked about the types of businesses. There are 4: the sole trader, the partnership, company, and cooperative. So we talked about a sole trader, which is the most common one, where one person runs the daily activities. A partnership, we have 2 or more individuals who own this business. A company is created by law and has ownership separate from the hands of the shareholders. Cooperative is a form of business which is owned by its own customers, like a market. They want to provide a common service at low cost. All right, so we have these questions. True or false? Bookkeeping is a subset of accounting. It is true. An accountant is only interested in analyzing business transactions. Is that true? False. It's not only analyzing. A sole trader is owned by one person. True or false?
True.
True. A cooperative is a form of business whose sole purpose is to make a profit. True or false? False. A business should
False.
be separate from its owner. True or false?
Both.
All right, so we have elements of accounting. So we have 3 fundamental elements. We call them assets, liabilities, and equity. Assets are things that a business owns and uses to generate cash. So we have 3 types of assets. We have what we call the current assets. These are the main assets that are converted into cash within a period of 1 year. We have cash, we have debtors, we have stock or inventory, we have prepayments. Fixed assets are simply assets which are used in the normal operations of a business. Examples: buildings, equipment, land, vehicles. We also have intangible assets. Intangible assets are simply assets that provide benefits to a business for many years. They have no physical substance, like goodwill, patents, trade name, a good name that a business may have. We call them intangible assets. Liabilities are simply the Congolese, the debts that a business owes its creditors. So these are called liabilities. If a business borrows money, it becomes a debtor. If a person lends us money, they become our creditor. So if a business fails to pay its debts when they are due, the creditor can claim any assets that we have as a business. So we also have what we call equity. Equity is simply what the business used to start its capital, its business. All right. So when the owner puts money into a business to start it, we call it owner's equity. In a partnership, it is called partnership equity. So owner's equity increases when money invested in a business is through the sale of goods or services. So a quick, can you remember? You can choose whether it's an asset, liability, or equity. Cash in the bank, what do we call that?
Current asset.
Current asset. Money from the business owner, what is called?
Capital.
Owner's equity. Furniture
Capital.
in the business is called what? Furniture in the
Asset.
is called
Asset.
an asset.
Asset.
Money owed to creditors are called what?
Liability.
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 Business loan from the bank is called what?
Liability.
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 The business trade name is called what?
Patent.
It's an intangible asset, like goodwill, we have a name. All right. So, the accounting equation has three elements. We have assets, liabilities, and equity. So when you start a business and you put money in it, it should either be put in the owner's as owner's equity, or you can borrow from the bank to start a business. These are two options. So the accounting equation, you should record your business, always separate the finances you put in. So agree to say the assets must be equal to the equity to start with. So assets must be equal to the liabilities plus the owner's equity, which we call capital. So this is what we call the accounting equation. So if on January 1, Mr. Fay, the owner of Carver Enterprises, borrowed 500 from the bank to start his business to add to his startup capital. So we're going to have the accounting equation as follows. Equity of 5,000 is equal to 5,500 minus a liability, then Congole. So this is how we write. So you need to understand the accounting equation by heart as an accountant here. So assets is equal to liabilities plus capital. So meaning capital is equal to assets minus liabilities. So you need to know how to navigate around these, they all point to the same thing. So we have a balance sheet, one of the cardinal books in accounting. The balance sheet shows the assets, liabilities, and the owner's equity at a specific period in time. So assets is equal to liabilities plus owner's equity. So these will show a balance sheet that must actually balance. So on 1st January, Fay commenced the business called Carver Enterprise by opening a bank account with a deposit of 5,500. So we can express it to start with that assets must be equal to equity. So using the balance sheet, our assets, we have cash. Our equity, we have capital, which is 5,500. So this must balance, meaning what we have as assets must be equal to our equity. All right, so I'm going to take you through at length the ledger account and how to balance them up. But I want us to understand, as I mentioned, to say the balance sheet should give you the classifications of items that we have. So we have assets that are divided into two. We have current and non-current assets. The current assets include cash, cash at bank, prepayments. We also have debtors and we have inventory, which is stock. The fixed assets are called non-current assets. They include buildings, motor vehicles, investments from with the company, organization, and other investment, intangible assets that could contain goodwill. Liabilities Current are Congolese that can be paid within a year, like owing electricity, owing rentals. And we also have long-term liabilities that can be paid within a period of after 1 year. So let's go to the quick can you remember. Write down the meaning of the following. What are current assets? What are fixed assets? What are intangible assets? Quickly. What are current assets?
Sir, I think for us to move quickly, maybe, and for the sake of having everyone participate, maybe it could just be pointing so that it doesn't look like only a few individuals are participating in this.
All right, that's a good one since I can read the name there.
Sorry, I've just joined in. So what's the question?
What are current assets? What are fixed assets and what are intangible assets? So we'll start with the current assets. So we'll have Helen and DK tell us what current assets are. Then Mali and Honest will tell us what fixed assets are. Salifanji and
Good evening, sir.
yes.
So current assets are assets that can easily be converted into cash.
Within what period?
About
Within a period of a year, correct. What are the examples of current assets? Any 4 examples of current assets? From the names I mentioned, any 4 examples of current assets?
What is cash?
Cash
So
advance,
there's
debtors,
inventory.
prepayments, inventory, correct. What are fixed assets? The next group. What are the fixed assets? These are
Okay, so fixed assets is the opposite of current, that cannot be converted into that cannot easily be converted into cash within the period of 1 year.
they're
So the
actually
examples.
meant for use in a business. So we have
Okay.
2 types of
So
expenditure. We have expenditure for goods to be resold. We call those inventory. We have expenditure on operational expenses. We call that revenue expenditure, like repairs, stationery, servicing, depreciation. That is called revenue expenditure. But we have capital expenditure, which goes to fixed assets. If we buy a vehicle for the company, if we buy fittings and fixtures for the company, if we buy fridges for use, those are called fixed assets. The other term for fixed assets is the non-current assets. Intangible assets are assets that you cannot touch but have a long life bearing on the institution, like goodwill, okay, which is a name of a company. For instance, if you want to open up your own filling station, like Total, you are going to be charged for the name. You're going to bear Total because it's part of an intangible asset. They have made their name. All right. So we talked about the balance sheet. Balance sheet, we have 2 types of balance sheets. We have what we call the account form and the financial position form. The account form is a visual representation of the accounting equation, where we know that assets is equal to what? Capital plus liabilities. And we also have the financial position format, which looks like this, where we have assets, current assets, owner's equity. which you predominantly use. So what have we learned so far? We learned that bookkeeping is a subset of financial accounting, which is defined as a systematic method of recording financial transactions, reconciling statements, and preparing financial reports. We've also learned that there are many types of business organizations, much of which could be sole trader, partnership, company, or cooperative. We've also talked about 3 fundamental elements in accounting, which are assets, liabilities, and equity. What else have we learned? That the financial equation gives the illustration of the relationships that exist between liabilities and equity. We've also learned that assets, the balance sheet shows the accounting equation where assets are equal to capital plus liabilities. So we also talked about the 2 forms of balance sheets, which we have the account form and the financial position form. So this is our exercise. So what is the missing figure there? Since we know assets is equal to liabilities plus equity, so this should also be 5,000. So this one, to get this, we just subtract this one from that. We'll get the balance there. When we add this one and that one, we're going to get the assets there. So this is how the accounting equation must be fulfilled. So state whether the following would be categorized as an asset, a liability, or equity. Savings at a bank, what do we categorize that as?
Current asset.
Good, the current asset. Money owed to lenders,
Liability.
Liability.
liability. Invested 5,000 into a business,
Equity.
owner's
Equity.
rent paid in advance to the landlord,
That's a prepayment.
prepayment, so it is a current asset. Excellent. A piece of land,
As
Fixed
asset.
an asset. Excellent. So create a financial position that will balance for these. I'm going to balance this up. So using the following information. So we start with the assets, the fixed assets. What assets do we have? What fixed assets do we have? Office and supplies. These are
Office and supplies.
2,000. Then current assets. Which current assets do we have?
Cash at bank.
And bank. So this is what? Cash is what? 4,000. Bank is what? 1,000. Now cash at bank is 4,000 and stock is 1,000 stock. So we have 2 plus 4, that's 6 plus 1, that is 7. Then down we're going to have equity, which is equal to 7 as well. So these assets should be equal to equity. So let's match each of these ones. We have 1, 2, 3, 4. So we should match them. For instance, here, owned by shareholders. Which one is owned by shareholders? It's a company. We'll put 3 there. So they are more interested in providing services at a low cost than making a profit. Who are these?
Partnership.
Partnership. Limited
Partnership.
company. Yes.
No. Try again.
Cooperative. Huh?
Cooperatives, yes, 4. Then owners share risk, liabilities, and management of the business.
Partnership.
Partnership, which is 2, is owned by one person,
Sole trader.
which is 1. Excellent. All right, so we got to unit 2, unless there are any questions in unit 1. So we're going to look at what we call accounting principles and concepts.
Mr. Collins, sorry, could you just share? I just want to see something on your previous screen.
Yes, please.
Oh, okay. So when we're the first question we did, we're adding to get the equity.
Yes.
Oh, okay. I didn't understand that part. I was wondering. Okay, thank you.
All right. All right, so unit 2 introduces you to another concept of bookkeeping, where we're going to align ourselves to what we call accounting principles and concepts. Accounting principles and concepts. So there are about 11 principles and concepts that you need to know. We have what we call the entity assumption, the going concern, the periodicity assumption, the money unit assumption, the historical costs principle, the objectivity principle, the revenue realization principle, matching principle, consistency principle, disclosure, and prudence. So we want to go through them one by one. What does the entity principle state? The entity principle simply states that an organization is separate from the owner who establishes it. So the affairs of the owner must not mingle with the business. So if Collins owns Class Tuition Center PLC, if we see him using the company car to the farm for personal use, then the company can sue him because they're abusing his power despite him being the major shareholder. Going concern simply states that the business should continue forever as a going concern. So as you may know, there are people who started a business and died, but the business still goes on today. A good example is Brian Bell, company which started in 1961. It's still strong even now. All right, Apple founder. We also have periodicity principle, which simply states that the results of the operation over a standard period of time, may be a day, a week, half a year. It is very important to show the period of time covered by reporting the heading of the statement. The money measurement principle simply says that as we record these transactions, we must ensure that they are in monetary form. This makes it easy for everyone else to understand the estimate of the value of their assets. So the currency in Zambia is kwacha, so we use that kwacha equivalent. The historical cost principle simply says that the assets and liabilities must be recorded at the acquisition price. For example, if a company where we bought land at 1,000 kwacha in 1990, or maybe 50 kwacha in 1990, today it is 100,000. So we're still going to record the acquisition value of 50,000 kwacha. So this is what we call the historical cost principle. So there are 11 principles. Before I go any further, let's do a quick, can you remember on the 5? So you give me the number that coincides with that. So which principle fits the following definition? A company's balance sheet should report its land at the price they acquire it. Which principle is this? Which principle is this? Samantha and
Historical.
Hysterical. Correct. Is she right? Is he right? 5.
Yes.
Yes.
A company account should cover the period of time. A company account should cover a period of time. What principle is that?
Periodical.
Periodical principle.
The periodicity 3, correct.
Okay.
Personal assets of the owner should not appear. The personal assets of the owner should not appear in the balance sheet. What principle is this?
Entity.
Yes, separate entity. That is 1, correct. A business will remain in operation for a foreseeable future.
Going concern.
Going concern. Transaction should be recorded in unit currency.
Monetary unit principle.
Excellent. All right, so we now continue. Objectivity principle simply states that All financial and accounting information should be independent of bias, should be independent of manipulation. It should be verifiable and auditable. The realization principle simply states that the price for which you pay the services is called revenue. So this simply means that the revenue is realized when recorded, not when the actual cash was received. So the revenue is recorded when you make a sale, whether cash was received or not. For instance, if you supply a customer with goods worth 1,000 today, you record it as a revenue today. All right, not when you wait for the 30 days. Matching concept is also called accruals concept, which simply says that costs must match the revenue earned in the same period. Consistency principle simply asserts that you can only adopt an accounting practice or method which you continue throughout the reporting period, not a power changer. You need to be consistent. Disclosure principle simply asserts that the business must provide all relevant facts and information in the financial statements, accompanying notes, so that the reader may be able to understand and make an informed decision, not partial information. It should be full disclosure. You'll give small notes down there to say this is that and that. Prudence principle simply asserts that you need to be careful or cautious, or make a good judgment when preparing these records. This simply means that we should be cautious when reporting financial information. If a situation arises where two acceptable alternatives for reporting an item are there, we should choose the alternative that will result in less net income or less net asset. So this will make sure that you will not over or underestimate your assets. In fact, it is important that you don't do so to avoid deviating the taxes that are due. So,
Mr. Collins, sorry, before you proceed, I have a question on the previous table, the one on the principles. Yes, this one. Oh, okay. No, I wanted to ask about the entity principle. Now I understand. Thank you.
All right. So what have we learned? Quick, can you remember? The entity assumption simply assumes that the owner and the business are two separate people. Going concern is that the business will continue for a foreseeable future. Periodicity simply says that you should report your result within a designated period of time. Monetary entity principle simply says that you should express in currency. Historical cost simply means that the price of the asset in the balance sheet to be based on its original, not present or current value. Objectivity simply means that the statement should be based on verifiable data. Revenue realization simply means that revenue must be recognized as soon as it is earned. Matching concept or accruals concept simply assumes that expenses should be recorded in the period in which they were incurred. For instance, you have employees who you are supposed to pay wages in 2021, but you haven't paid them, but they have given you the service. You need to charge in your statements that wages have been enjoyed, but as an accrual, so charge them. If you prepay your rentals in advance for next 2 years, don't charge your income statement, just charge what is particular for that particular year, because people who do that will understate or give a false figure for your profit to avoid taxes. Consistency, meaning you should adopt one method throughout your reporting. Disclosure principle, you should provide all necessary information needed to understand the statement. Prudence, you should not overstate your assets or income or understate your liabilities and expenses. Quick, can you remember which principle is it that all transactions should be recorded? Which accounting principle is it that Brian Bell started a business, however, he is not alive, but is still in existence? Which principle exists that accounting reports must be reported every year? Which principle exists that personal affairs must not mingle with the business? Which principle exists that revenue must be earned and must agree with the course that were incurred. So here you give your answers based on what you remember. Who remembers? Pick any of them, 1, 2, 3, 4, quickly.
Number 2 should be going concern.
Going concern. Correct. Ngawalia wire. So we're ending now. If you don't answer, you remain going concern. Next.
4 is entity.
4 is entity, personal, affairs, mingo too. Yes. Pick any. Are you able to see them? Going to scroll so that you choose.
3 should be periodic.
3 must what? Periodicity. 1 and 5. You can answer them.
5 is matching.
Matching. And 1. Full disclosure. All right. So thank you so much for your time. We have just covered a part of the units.
Sorry, sir. Is it possible to share what we have covered? The notes that
All right.
are here.
And the video.
Sorry?
I'll share the notes in the
Yes, and the video, please, Mr. Collins.
All right, okay. Those that are not on the group, please, you inbox me so that you added on the group. So we end here for now. 2030, we'll continue from here until we learn how to do the ledger entries, how to put debit, credit. For you to understand and appreciate that, you need to understand bookkeeping. So bookkeeping is for grade 1. So in your grade 1, we call you the BIDs, brought in date. So you need to understand these basics to appreciate what comes later on. Thank you so much for your time. Have a good evening.